Hello and welcome. In this video, we will understand what a rights issue of a share is. Okay. Now, before I explain the concept to you, let me give you an analogy. Alright. Let us say that you go to a market to buy apples. Okay. When you go to the market and ask the person who is selling the apples about the price, he says that 1 kg of apples is 200 rupees. Okay. Meaning, if you want to buy 1 kg of apples, you will have to pay 200 rupees. But then he says that if you buy 2 kg of apples, you will have to pay or you can pay 300 rupees. That means if you buy 2 kg of apples, the effective price per kg of apples will be 150 rupees. Alright. Now, you can go for this option. But there is no compulsion. There is no requirement that you have to buy 2 kg of apples. You can buy them and get a good price, but it is fine if you do not want to buy also. Okay? Yes. Now, this was just an analogy for a rights issue of shares. Alright. Now let us go to the actual example. Let us say that a company has 10,000 shares. Okay. And the total owner's money is 50,000 rupees. Alright. Now this is called as market capitalization, which we will learn in a different video. But to keep it simple, think of this as the amount that the company has to conduct its operations. Okay? Now, the company decides to expand its operations. Okay? It wants to expand its business. And to expand its business, it needs 70,000 rupees. Alright. It has 50,000 rupees with it. But now to expand, it needs 70,000 rupees. So 20,000 more rupees is required. Okay. Now it has options. One is to take a loan from the bank. Okay. If the company takes a loan from the bank, then it has to pay interest. Correct? This is called as debt. It doesn't want to do this. It doesn't want to pay interest. And so the company doesn't want to take a loan from the bank. The second option would be to go for an FPO, follow on public offer. If the company goes for this, then the number of shareholders will increase. Okay? And the company doesn't want that either. So we have something called as voting rights, which we will learn at the end, which will increase if it goes for an FPO. So it doesn't want to do that. Okay. What is the other option, if there is any? The other option is to offer a rights issue of shares. So what the company does is, it decides to offer shares, new shares, to existing shareholders at a discount. Okay? Meaning, the ones who are holding shares of the company will be offered new shares at a discount. Okay. Now, this is also done in a ratio. Alright. So let us say that the company decides to offer shares at a ratio of 1:2. Meaning, if a person has one share of the company, he is entitled to buy two shares at a discount. Okay. Now let me give you an example and explain the concept. Alright. On the left side is the scenario before rights issue. And on the right side is after the rights issue. Alright. Before the rights issue, the market price of one share of the company is 100 rupees. Alright. That means if you want to buy one share of the company, you will have to pay 100 rupees. Okay. So it is 100 rupees per share or per stock. And let us say that a person named Ravi has 100 shares. So the value of shares owned by Ravi is 100 multiplied by 100, which is 10,000 rupees. Okay. This is the value of shares owned by Ravi. And this is before the rights issue. Alright. Now let us say that the company decides to issue rights for shares at a ratio of 1:2. Then after the rights issue, Ravi is entitled to 200 shares. Okay, 200 shares. Now he can buy 200 shares at a discount. Now what is this discount? This discount will be on the market price. In other words, the price will be less than the current market price. Okay. The market price is 100. At a price less than 100, Ravi can buy 200 shares. Alright. Now it can be of any value. It will be set by the company and it depends on various factors also. Okay. So do not worry about the price. Let us say that the company decides to offer shares at 60 rupees each. Okay. So the market price is 100 rupees. The discounted price is 60 rupees. Alright. The company decides to offer extra shares at 60 rupees each. Now this is a rights issue. Ravi can exercise the right. He may buy the shares at this price, or he may pass. He may pass the offer. Alright. If he decides to pass on the offer, then he can sell the rights to others. Okay. The rights themselves have value. In most cases, the rights are renounceable, meaning the shareholder who doesn't want to buy the shares, like Ravi, can sell his rights on the stock market to another investor. That another investor then pays Ravi for the rights and can use them to buy the discounted shares from the company. Alright. So Ravi has an option to buy the shares or leave them. Okay. Now let us say that Ravi decides to buy 200 shares at 60 rupees each. Then the price to be paid is 60 into 200, which is 12,000 rupees. Alright? So he has to pay 12,000 rupees. So after the rights issue, the total shares owned by him is 300. Okay? Now, what about the market price? The market price or the share price is mathematically expected to fall immediately after the rights issue begins trading. Okay? This is not just due to the market sentiment. It is because new shares are being issued at a lower price and the total value of the company is now spread over more shares. Okay? There is a formula to calculate the price which gives an estimate of the new market price. But do not worry about it. Okay? The market sentiment also plays a role, but the initial drop is a predictable adjustment. Okay? Now, these are not bonus shares. You are not getting something for free. You are not getting something extra. You have to pay here and you have a choice whether to buy or not. In the case of a stock split and bonus shares, they were given to you. They did not ask you whether you wanted them or not. They give you bonus shares, they split your shares, but here you have an option to buy or not. Alright? Yes. Now, why does the company want extra money? The company may want to expand its business, or the company may want to pay off a loan that it already has. For other reasons also, the company may want to offer rights issue. Okay? Now, if the company is offering a rights issue to expand its business, then it is good. Because when the company expands, its business increases. And so does the profit that the shareholders get. But if it is offering a rights issue to pay off a loan, then the money that the company gets by selling extra shares goes to pay off the loan. Correct? That means the company is not expanding. That means the money is not being used for making a profit, which is bad for the investors. Right? So when you hear that a company is offering a rights issue, look at the reason for which it is issuing it. Whether it is to expand the business or to pay off a loan. Alright? The former is good, meaning this is good and this is bad. Okay? So this is a general opinion. Alright? Yes. Now, the next point as an investor. From the point of view of an investor or a stakeholder, let us say that before the rights issue, you have a 1% stake in the company. That means you own 1% of the equity. Alright, 1% of the shares of the company. Now, when the company says that it is going to issue rights, you have a choice. Correct? You can buy extra shares at a discount or you can pass on the offer. Now, there are advantages and disadvantages associated with this too. If you decide to buy the extra shares at the discounted value, then you maintain this 1% intact. Okay? So, before and after the rights issue, if you buy the shares, you will maintain your 1% stake in the company. But if you decide not to buy the shares at the discounted price, then your stake will decrease. This 1% that you own in the company will decrease. Alright? So that is the disadvantage of passing on the offer. Next, you may have a doubt or a question. You may ask me, I will buy the shares of the company as soon as it announces a rights issue or bonus stocks or a stock split. And as soon as I buy them, I will be entitled to them. Correct? So that is the question you may ask me. But that is not so. You cannot do that. Alright? If, for example, the company announces bonus shares or a stock split or a rights issue on July 15th, then it will give a deadline before which a person must own the shares of the company to be eligible for these. Alright? The company will say that if you have bought a share of the company before July 13th, then you are eligible for either bonus shares or stock split or rights issue. Okay? So these are two random dates, alright, just to make you understand the concept. So if the company announces these on July 15th, it will say that if you have bought shares of our company before this date, then you are eligible for them. So if you buy the shares on July 14th, then you are not eligible. If you buy on 15th, you are not eligible. Alright? So you cannot buy the shares after the announcement of these to be entitled to them. Alright? So this is about rights issue of shares. I hope you have understood the concept. Okay? Now, I want to talk about the voting rights of shareholders because people generally confuse rights issues and voting rights. Both are different. Okay? We learnt what a rights issue is. Now, let us proceed for voting rights. Okay? So basically, shareholders have a provision to vote on the crucial matters of the company. For example, if I am a shareholder of a company, let us say Infosys, then I will be given voting rights, or I will have voting rights to vote on crucial matters of the company. Now, what is a crucial matter? The company may be changing its board of directors, or the company may be venturing into a new area. On these matters, the company will ask for votes from its shareholders. And when it asks, we can vote on it, or I can vote on it. Okay? So, changes in corporate policies or changes in the board of directors or any other financial investments or operational decisions or the approval of dividends also. Alright? Acquiring other firms or mergers, these are also crucial matters. On all these matters, the company will ask for our opinion on the matter or ask for our vote. So, we or you, being a shareholder, have a right to vote on all these matters. Alright. Now, the thing is that for you and me being retail investors, our vote doesn't count for much. Okay? It doesn't count for much. Now, if you consider a political election in a country, for example, if you consider India itself, we can cast one vote. Correct? So, I have the right to cast one vote to choose a politician. But when we come to corporate voting, the number of votes a shareholder has is directly proportional to the number of shares that they own. For example, if a particular shareholder owns more than 50% of a company's shares, then in that case, they have a majority vote or a controlling interest in the company. Okay? And their opinion will have a huge impact on the company's policy. Alright? So, we as retail investors will be having 50 shares, 100 shares, 200 shares, 1000 shares, and so on. All these are small amounts, and so our votes do not count for much. Okay? So, I hope the difference between a rights issue and voting rights is clear. Okay?